Good morning and welcome to the July 26th edition of GPS Global Wallet. Throughout 2023, FX volatility has been trending lower amid range-bound markets. Volatility reached the lowest level earlier this month, and there has been a small rally. Across all currencies, the term structure of volatility has become more inverted, with short dates rallying more than longer dates. The option prices seen in the market imply more movement is expected over the short term. Throughout 2023, and particularly over the last few months, volatility has been trending lower. Here's a chart displaying the trends since April 2023 for the 3-month Euro-USD market implied volatility. The reason for the lower volatility has been driven by market spot movement, as seen in this chart, showing the percentage movement in major currencies against the US dollar over the same period. Although daily movement has been observed with news and data releases, the market has been largely range-bound, which has driven option volatility lower as a result. The expected movement of the spot market determines the implied volatility and in turn the option prices. It can be observed that volatility is usually elevated around key market movement events and lower around times when markets are quiet, such as holiday periods. A couple of weeks ago, after the 4th of July break, markets certainly had that holiday feel. However, since then, uncertainty has returned and volatility has rallied. It is worth noting that volatility is not just a single figure. It has term structure, as the markets cater for options of all dates to satisfy those both hedging or for those trading the market. The term structure at the extremes has two forms. Firstly, the term structure can be normal. In a normal curve, volatility increases as the time to expiry increases. The second curve, it's an inverted curve, where volatility is highest for short-dated options and then decreases as the time to expiry increases. This chart shows the US dollar and Aussie term structure of volatility increasing and moving from flat to inverted. The lower curve is for the 14th of July and the upper curve is for the 26th of July. US dollar Aussie is a risk currency and signals a spot movement is expected for the short term rather than the long term. Looking at the chart for Euro-US dollar term structure, we see volatility increasing. The lower curve is for the 14th of July and the upper curve as the 26th of July. The shape of the curve in this case has not changed significantly. The chart for the US dollar yen term structure also shows volatility increasing. The lower curve is for the 14th of July and the upper curve as of the 26th of July. As you can see, the demand for the shorter date option has made the curve more inverted. The USD CAD chart shows the term structure of volatility moving from normal. The lower curve is for the 16th of July and the upper curve for the 26th of July. The curve has been quite normal, indicating that movement is expected less in the shorter term. After the change, the curve is almost flat. This chart shows the pound USD term structure of volatility increasing and move from normal to inverted. The lower curve is for the 10th of July and the upper curve as of the 26th of July. In this curve, longer dated volatility has fallen and short dated volatility has risen significantly. The analysis of the term structure of volatility across major currencies indicates the market sentiment has shifted over the past 2 weeks. Short-term uncertainty has replaced the quiet northern hemisphere summer vibe. The key driver of FX remains the data, which in turn alters the expectation of monetary policy. This data will be closely watched, as should any open exposures over this period. That's it from us. Enjoy the rest of your week.